welcome. So I want us to discuss on accounting for cooperatives. I had already shared with you the notes in advance, so that I want us to discuss. I want us to discuss the theory part, and then I'll do some computation on how to account for cooperatives. And you know what a cooperative society is? Just an association of people with common interest where they form like a group, and then they'll be contributing some amount for the benefit of the members. That's what we call the cooperatives. So I want you to take out your notes. Take out your notes. I already shared with you the notes. I want first of all go through the theories. Go through the theories. Now, hoping we are there. Want us to discuss now. And what are cooperatives? Now, cooperatives are voluntary association of people who work together to promote their economic interest. Therefore, it's a form of business where individuals belonging to the same class join their hands for the promotion of the economic goal. Now, the philosophy of cooperative formation is it's all for each and each for all. Yeah, and cooperation works with feeling of help others. Yeah, most of the cooperatives, they're saying that in this case, for you to form a cooperative, now cooperative, the members have common interest, like farmers cooperative, teachers cooperative, police cooperative, all that. And what are some of the characteristics of cooperative society? Now, cooperative society is a form of business. So sometimes they run a business. So therefore, what are some of the characteristics of cooperative society? Number one, there is a voluntary association. No one is forced to join the member, to be a member. Also, there is open membership. There is democratic management. Yeah, actually, the members are the one with the power to elect their leaders at every time they are having an AGM. So there is democratic management. Also, the service motive. Their major objective is to offer services to the members. Also, on how to utilize the surplus. Also, there is self-help through mutual cooperation. Also, they have fixed rate of return. So their main objective of cooperative, I don't wish to discuss them because that's very simple. It will kind of go through the theories on a cooperative. We look at the main objective of cooperative, the role of cooperative. Yeah, they are well summarized. Also in page 2, there is merits and advantages of cooperative society. Yeah, they are very simple. Also, the limitation of cooperatives, type of cooperative society. I also have highlighted some differences between cooperative and companies, including the factors responsible for the survival of cooperative organization. Well summarized. Also, I've also summarized the problem facing cooperative society, also the solution to those problems. Then I have provided some illustration there. I want us to do an illustration. We do a question from the past paper because the major focus in this area, I just want to show on how to account. That's why it's financial reporting. How do cooperative society present their financial statement? Now, cooperative society sometime, when the members join, when a new member joins, there is an entrance fee. So that means entrance fee to a cooperative society or any circle, it's an income. Also, sometimes they collect the savings from the members and then they rent to those members. So that means if they rent to those members, you expect the member to pay back with a small interest. Now that interest of the cooperative society also becomes an income. So therefore, sometimes cooperatives, they might act like a bank. And you know how the bank operates. So there is loan to members. Now, whenever a cooperative or a bank give loan to member, so they expect to receive back plus the interest. And in that case, what happens? In that case, what happens is that so I was saying that when they give loan to members, they expect the member to pay back the loan with the interest. So that means the interest to the cooperative or to the bank is an income. Also, when the customer deposits their money in form of savings, so they expect to receive back with the interest. So we have what we call the customer deposits. Now, customer deposit to a cooperative or to the bank, this one is a liability. Why? Because these are some of the money they are holding that does not belong to them. This money belongs to the members. So if it belongs to the members, so the members expect at the end of the financial year to either receive the dividend or to receive the interest. So here there is interest. So that means interest on customer deposit or customer savings to the cooperative society or to the bank, it's an expense. But the interest on loan to the cooperative society or to the bank, it's an income. So what does it mean? That means customer deposits, it's a liability because a liability gives rise to an expense. Loan to member, the bank or the cooperative, they expect to receive back with the interest. So that means loan to members, it's an asset because an asset gives rise to an income. Good. So now with that, let's do an illustration. We can do an illustration. So open with me. I want us to do one question from the past paper. December 2022, question 2. December 2022, question 2. December 2022, question 2. So hoping we are there. So I want us to go through that question. Now, Marura Farmers Cooperative Society Limited deals in the marketing of 2 brands of coffee, Safi and Zuri, on behalf of the members. As per the society bylaws, the society is allowed to retain 20% of the sales from Safi and Zuri for operation and to pay the balance to the car. Yeah, I told that. As per the society bylaws, the society is allowed to retain 20% of the sales from Safi and Zuri for operations and pay the balance to member. So they retain 20%. So in short, that's what we call the commission. They retain 20% and then they remit the balance of 80% to the members. The following trial balance was extracted from the books of the society as at that 1st of December 2021. So we have Safi, where you have the marketing expenses, processing material, processing wages. Now those are the expenses incurred by this society in marketing Safi. Also in Zuri, there is marketing expenses, processing material, we have processing wages. Then we have loan to members. Now, loan to members to this cooperative, it's an asset. So can you indicate it as A? Rate it as A. Loan to member, it's an asset. Even you can see it's on the debit side. We always debit the expenses as well as the asset. We credit liabilities, equities, and income. Good. Then we have dividend from investment. It's on the credit. So therefore, that one is an income, rate it as I. Accrued rent, that one is a liability, the current liability. Sundry provision, that one is a current liability. Appropriation account. Now, appropriation account is equivalent to the retained earnings, the same as retained earnings. We have revaluation reserve, that's a reserve. Statutory reserve fund, it's a reserve. Entrance fee. Now, entrance fee to cooperative, it's an income. So that's why it's on the credit side. You see that we credit the liabilities, equity, and income. So entrance fee is an income. Share capital, that's part of capital. Members deposit. We see that members deposit is a liability because the amount we are holding here does not belong to the cooperative, it belongs to the members. So therefore, the member deposit is a liability to a cooperative because that's not their money. So that's an uncurrent liability. Sundry creditor, that's a liability. Then we have bank overdraft, current liability. Interest on loan to members. Interest on loans to member. So is it an income? Is it an expense? Yeah, correct. That's an income. That's an income. Then we have traveling expenses for staff, committee members. So those are the expenses. We have the bank charges, bank interest and expense, salaries and wages and expense, committee education and expense, committee sitting allowance and expense, printing and stationery and expense, general meeting expenses. We have members' education, entertainment, legal fees, cash in hand, that's a current asset. Wakulima Bank, limited savings. So savings to the cooperative, that's an asset. Investment in Wakulima Bank, investment their assets. Receivable from members, it's a current asset. Receivable from non-members, it's also an asset. Office equipment, that's an non-current asset. Additional information. Bora Limited markets Safi and Zuri brand for Marura Society. On that 1st of December 2021, Bora Limited sold Safi and Zuri brand $175,000 US and $115,300 US respectively. Bora Limited remitted the above amount to Marura farmers Wakulima Bank account on 15th of January 2022. Marura Farmer Cooperative Society does not maintain a US dollar account in Wakulima Bank. Number 2, the exchange rate for the two currencies were shown below in respective dates. So we have the Kenyan shillings per $1 US. We have that 1st December 2021. Now that's at the end of that financial year. 15th of January 2022. Now that was the date that amount was deposited to the account. Number 3, audit fees of 6 million is to be provided for. Number 4, staff salaries and wages amounting to 3.2 million had not been paid as at that 1st of December 2021. Interest on members' deposit is to be provided at 86,000. As per the relevant ministry regulation, cooperative societies are required to transfer 20% of their net earnings to statutory reserves. Required. Prepare the following financial statement for Marura Cooperative Society Limited for the year ended that 1st of December 2021. A is Safi brand marketing account showing the profit or loss. Safi brand marketing account. So how do we prepare that? So how do we present that financial statement? So number A, yeah, to present Safi, yeah, marketing account. We want to determine the profit or loss. So we start by recognizing the sales. To get the sale, now let's go to note number 1. We go to note number 1. Bora Limited markets Safi and Zuri brand for Marura Society. On that 1st of December 2021, Bora Limited sold Safi and Zuri brand $175,000 United States dollars and $115. So Safi, they sold $175,000 US. So you convert it into Kenyan shillings. Remember, these are Kenyan companies, so we need to present in Kenyan shillings. Then we are told that Bora Limited remitted the above amount to Marura farmers Wakulima Bank account on 15th of January 2022. Can you underline that? The date, that's the deposit date. It was deposited on 15th of January 2022. Marura Farmer Cooperative Society does not maintain a US dollar account in Wakulima Bank. So that means we cannot use to hedge. So that means when converting this amount, the amount was deposited at what we call the spot rate. Spot rate, that means at the date of the deposit. Note number 2, the exchange rate for the two currencies was shown below on the respective dates. That 1st December 2021 and 15th of January 2022. So the deposit rate was 15th of January 2022, and the rate of Kenyan shilling per US dollar was 100. So 100 US dollars. And thus I'll get an amount of 17,500. That was the sale. Then we raise expenses. expenses. Now let's go to the trial balance. We go to the trial balance. The trial balance, the first item we have in the trial balance was SAFI expenses. We have marketing expenses. Also, we have processing material. Also, there was processing wages. So this was an amount of 640. This was an amount of 860. You can just do this. 640. We have 860. We have 900, and that's how we determine the profit. So give me the profit. So I'm the one now using the calculator. 17,500, because today I'm maroon. 640, you minus 860, you minus 900, and you get an amount of 15,100. Then from there, you need to show the amount of remittance, what we call the payment due to members. Payment due to members, so that we see the retentions. Now, the retentions now will be their profit or the commission for marketing. What does it mean? Now, let's go back to the first paragraph of the question. First paragraph of the question. Now, first paragraph here to that. Marura Farmer Cooperative Society Limited deals in the marketing of 2 brands of coffee, Safi and Zuri, on behalf of the members. As per the society bylaws, the society is allowed to retain 20% of the sale from Safi and Zuri for operation and pay the balance to members. So you're supposed to retain 20% of the sales, not 20% of the profit, 20% of the sales. If you retain 20% of the sales, that means we remit 80% of the sales to members. 80% of the sales, not of the profit, of the sale, 17,500. So how much is that? So if you take 80% of 17,500, you'll get an amount of 14,000. That's what you remit to member. So that means the balance will be the value of the retention or the commission, which will be an amount of 11. Or alternatively, this is what it means. We are told that the society is allowed to retain 20% of the sale. So if we retain 20%, the sales was 17,500. So 20% of 17,500. This is what you're supposed to retain. 35 from the sales. Then we are the one incurring all the expenses in the marketing process. So you raise the marketing or you raise the expenses. And these were the expenses. We incurred marketing expenses, processing material expenses, processing wages expenses. So you take 640, you add 860, you add 900, and you get 24. So of what we retained, the gross commission, we deduct the expenses we incurred in the process of raising that revenue, and you'll get the net commission retention is 11, which is the same as this. So it's as simple as that. So you can use either of the approach. And therefore, now this 1100 is what now you take it to the income statement as part of the commission received from other brands for marketing them. So it's another investment income. Number B of the question, number B. Number B, you have to present Zuri brand marketing account showing the profit or loss. Zuri brand marketing account. Also, here you do the same. Just take the sales. Note number 1, additional information number 1. In relation to Zuri brand, we sold $115.3 US And then we deposited on 15th of January. So the rate was 100. So you'll get an amount of 11,530. Then we deduct the expenses. We deduct the expenses. We go back to the trial balance. We go to the trial balance. So we are evaluating the expenses. Now in the trial balance, we had the expenses. There was marketing expenses. Also, there was processing material expenses. Also, there was processing wages. So for the marketing, there was an amount of 150. Just do this. 150. We had 320. And we had 30. So we had the total expenses. So that's 500, right? And that's how we get the profit. Now give me the amount of profit. So it's so the profit will be 11,530. You minus 500. You'll get an amount of 11,030. Now, once you get that, then you deduct. And so that's the amount of profit. Then there is payment due to members. Payment due to members. We were to retain 20% of the sales. So that means we remit 80% of the sales. So you'll take 80% of the sales, which was 11,530. Remember, we are not remitting 80% of the profit. We are remitting 80% of the sales. So 80% of 11,530, you get an amount of 92.24. So what we get here is our net commission or the retention, which is our net commission income. So I take 11,030 minus the answer, which is 18,06. Yeah, which is equivalent to, you take 11,530. You see, we are supposed to retain 20% of the sales. So you take 20% of 11,530. So 20% of 11,530, and you get an amount of 23,06. Now that's what we are retaining. But in the process of raising this revenue, you incurred some expenses. So you deduct those expenses. And the expenses incurred, the total expenses here we had was an amount of 500. So you minus 500. So that you get now the net commission. So it's 23,06. You deduct 500 and you get an amount of 18,06. Now this 18,06 is what you'll take it to the income statement as the net commission income. The net commission income. Good. So I think we're done with that. Part C of the question. I go to part C of the question. Part C, we are to prepare statement of profit or loss for the year ended that 1st of December 2021. That's the same as the income statement. And what's the name of this company? So this is Marura Farmers Cooperative. for the year ended 31st of December 2021. Our shillings are in thousands. So we start with the incomes. Start with the incomes. So to the incomes, number one, there was, first of all, you can start with commission on marketing. So income, we have commission on marketing. Or we have from Safi brand, as well as Zuri brand. So you take the net commission. So here we had 1100. And here we had 1806. 1806. Then there was dividend from investment. So there is dividend income. And the dividend from investment was an amount of 470. Also, there is entrance fee. Entrance fee. Now, the amount of entrance fee was 300. If you want to determine the incomes, just look at what has been credited. Don't look at the debit side. Look at what has been credited. That's where you get the incomes. Then there was interest on loan to members. So we gave the loan to members and then they paid the interest. So that interest would be an income. Get an amount of 35,890. Good. So even we can get the total income. So now let's add the total income. So we have an amount of 1100, we have 1806. We have for 70, we have 300, we have 35,890. You get an amount of 39,566. Then we deduct the expenses. Now expenses, they are debited. So you look on the debit side, look at the debit side. So for the expenses, we have traveling expenses. And for the traveling expense, we have for the staffs, and then we have for the committee members. So here we have an amount of 80. You have an amount of 100. Then there is bank charges. Bank charges was an amount of 200. Also, there was bank interest. An amount of 810. There is also salaries and wages. Now, salaries and wages is an amount of 2290. Then you add. What do we add? So now let's go to the additional information. Additional information number 4. Additional information number 4. Number 4, you're told that staff salaries and wages amounting to 3.2 million had not been paid as at that 1st of December 2021. So you add 3.2. 2290 is what was paid. This is what has not been paid. So you determine the total expense for the year. Then this, that too, the one we have not yet paid, will also affect the balance sheet as part of the current liability. It's what we call the accrued salaries and wages. So this is 5490. And then we have committee education. An amount of 1,000. Committee sitting allowance. For the committee sitting allowance is an amount of, we have an amount of 1110. Then we have printing and stationery. And for the printing and stationery is an amount of 2050. Then we have general meeting expenses. General meeting expenses. Now for the general meeting expenses was an amount of 500. We have members education. For the members education, it's 1500. Entertainment. An amount of 50. Also, there was legal fees. Yeah, legal fees an amount of 400. And then let's go to the additional information. Additional information number 3. Number 3, we are told that audit fees of 6 million is to be provided. Audit fees. We need to make a provision of 6 million. If you're making a provision, that means has not yet been paid. If it has not yet been paid, it will also affect the liabilities, part of the current liability. We have made a provision, but we have not yet paid. So audit fees was an amount of 6. Then additional information, number 5. Interest on members' deposit is to be provided at 86,000. Interest on member deposit is that members' deposit is a liability. So a liability gives rise to an expense. So there is we expect to pay the members on their deposit an interest. So therefore becomes an expense. So we have interest on members' deposit. Interest on members' deposit, and we have to make a provision of 86. And that's how we determine the net profit. I think we're done with all the expenses. Net profit. So now let's compute that together. Compute that together. So I'm getting an amount of 14,190. Hope you are getting the same. I hope you're also computing. Then part C, Rastri. Part C of the question. We are to prepare the statement of financial position as at that 1st of December 2021. So We have the statement of financial position as at 31st of December 2021. So shillings are in thousand. Have the assets, non-current assets. So what do we have to the non-current assets? So all the assets are debited. Now, we have loan to members. Now, loan is an asset. Loan to members. Amount of 972,340. Yeah, because we give loan to members with an expectation that they'll pay with the interest. So which interest is an income. Now let's go to the last item in the trial balance. The last item in the trial balance, we have office equipment. An office equipment is an non-current asset. We have an amount of 900. Also, we have investment in Wakulima Bank Limited. Investment in bank. Amount of 26,550. Then I think the rest are current assets. And for the current asset, we start with the second last item in the trial balance. We have receivables. We have receivables from non-members. Also, we have receivables from members. Receivable from non-members is an amount of 22,500. Receivable from members is an amount of 26,90. Then we have Wakulima Bank savings. Yeah, savings, they are part, we can call them cash at the bank. Yeah, so Wakulima Bank savings. Yeah, that's the cash at bank. Amount of 6780. We also have cash in hand. Cash in hand is an amount of 540. 540. Do we have any other asset? I don't think we have any other asset. Don't think. We also have some cash. Cash held on behalf of members. Cash held on behalf of the members. Why do we have that cash? Can you see that? Yeah, the unpaid coffee cash. You're still holding that cash. Yeah, you see, we made sales. Okay, this is what I mean. This amount was remitted on 15th of January 2022. But when is our reporting date? So our reporting date was on that 1st December 2021. Now, if the money was deposited on January 2022 on 15th, that means at the end or at the reporting date, we are still holding that cash. So show the cash held on behalf of the members. Actually, it was not on behalf of the members. Yeah, for marketing. Cash held on behalf of Nzuri and Safi brand. Here we held an amount of 17,500. Here we held an amount of 11,530. 11,530. So how much is that? 17,500, 11,530. We get an amount of 29,030. Now let's start the total asset. We had to get the total assets. So I'm getting the total assets we have is an amount of 1061 330 1061 330. Then you go to the other part where you have the equity and liabilities. For the equity and liabilities, we have the ordinary share capital. Ordinary share capital. For the ordinary share capital, it's an amount of 900,000. Then there is statutory reserves. Statutory reserves. Now, statutory reserves we have is an amount of 13,740. Then we have revaluation reserve. For revaluation reserve, it's an amount of 750. Then we have appropriation account. We said that appropriation account is the same as retained earnings. So appropriation account. Now, appropriation account, we had an amount of 6050 plus. Now, let's go to note number 6. Note number 6. Note number 6. In note number 6, we're told that as per the relevant ministry regulation, cooperative society are required to transfer 20% of their net earning to statutory reserve. So, of the net earnings for the period, 20% to be transferred to statutory reserve. That means we only retain 80%. So that means 80% will go to the retained earnings. We transfer 20% to statutory reserve. So to the statutory reserve, you take 20% of the net profit for the period, which is 14,190. Then to the appropriation account or the retained earnings, you take the balance brought down. Then you take the retained earnings for the period or the profit for the period, but only 80%, since we have transferred the other 20%. So you take 80% of 14,190. What do you get? So 14,190 multiplied by 0.2, then you add 13,740. You get an amount of 16,578.8 times 14,190. Then you add 6050. You get an amount of 17,402. Then we go to the liabilities. Now, for the liability, I didn't see in non-current liability. All of them, they are just current liabilities. So we have the liabilities. Now, to get the liabilities, you look on the credit side. We have number 1, accrued rent. Accrued rent was an amount of 49,50. Then there was sundry provision, an amount of 89,30. And there was also sundry creditors. Sundry creditors was an amount of 3410. Then we have bank overdraft. For the bank overdraft, it's an amount of 6150. We have other liabilities. Okay. Then we also have Now let's consider the unpaid expenses. Note number three. Audit fees of 6 million is to be provided. So we have not yet paid, but we have made a provision as an expense. So we have accrued audit fee. Accrued audit fees, an amount of 6 million. Number 4, staff salaries and wages amounting to 3.2 had not been paid. So we also have accrued salaries and wages. Yeah, we had not yet paid an amount of 3.2. So allow me to use this space here. Also, note number 5. Interest on member deposit is to be provided at 6086. That's an expense, but we have made a provision, but we have not yet paid. So therefore becomes a current liability. Yeah, interest on members deposit. An amount of 6086. What else do we have? We also have payment due to members. Payment due to members. Now, reason up here. Now, in our current asset, we showed the amount of cash held on behalf of the brands, of which, yes, we collected the money. That money does not belong to us. It belongs to those brands, but we still held the cash. So you show it as an asset. But all that cash, we have some which you recognize as an income, your commission. But you have the amount that now you're supposed to remit to the brands. So the amount due, not just to member, the amount due to brands, it's a liability, and here they are. Payment due to members or due to brands. So you had an amount of 1,400, it's 14,000. Also from Zuri brand, of the profit you have payment due, which is an amount of 92.24. That money does not belong to us, but we accounted for it as an asset because we still held the cash. But of this cash held, some are supposed to remit back to the members, of which we remitted after the year end. So therefore, at the end of the financial year, there were liabilities outstanding. Take 14, you add 92.23, get 23, 224. Now give me the total assets, add the total assets. I mean total equity and liability. What have we not included? We also have another liability. Yes, that's why it's not starting. Yeah? Can you see the members deposit? Yes, we have members deposit. Yeah, member deposit is liability. So include it here. Not yet included that, members deposit. Now, members deposit this liability, of which the members deposit was an amount of 64,650. So I think now it will tally. So you add 64,650 Yeah, and you get 1061 or 330. But it's as simple as that. So you can look at that for a few minutes. Just look at that. Now you already have the notes. The notes I had shared with you. It's on the last page. The last page. And then this is the second illustration. I have done illustration 1 on your notes. So illustration 1, there is a question, there is a solution there. So you can go through that the question and the solution. Now what we have done was illustration 2, the one for December 2022, question 2. Can just look at that, a few minutes. Good. So that's all about accounting for cooperatives. So I want us to look at something else. look at borrowing cost. That's under IAS 23. So don't copy, just reason. Now we shall also discuss this mostly on accounting for assets and liability later on how to account for the borrowing cost. It's provided for by IAS 23. Now, borrowing costs, these are the costs associated with borrowing. And the costs associated with the borrowing, such as interest. We also have the principal. Also, we have what we call the flotation cost, the cost which was incurred in the process of raising that fund. And how do you account for borrowing costs? Now, borrowing costs, number one, we have some borrowing costs which are expensed. That means they are taken to the income statement. And then we have the borrowing costs which need to be capitalized. Yeah, so that's how we account for the borrowing costs. Now, borrowing costs should be expensed. That means you take it to the income statement. And also, if that cost, the amount that was borrowed, for example, if you borrow an amount from the bank worth 10 million to construct a house. Now, this asset acquired or constructed by using the borrowed fund is what we call a qualifying asset. Qualifying asset. Now, the question is in this case on how to account for the borrowing cost. If you acquire this house or you build this house at 10 using the borrowed amount of 10, remember if you had borrowed 10 million, you won't pay 10 million. You'll have to pay the principal, which is 10 million, plus the interest or other borrowing costs. So that cost, we have some costs that need to be capitalized to this value of the qualifying asset. Yeah, so you add that expenses or what we call now the borrowing cost. So that means when determining now the value of this house, it won't be 10 million. Yes, we incurred 10 million, but also there are some expenses which were incurred in the process of raising that fund or in the process of constructing that house, such as the interest. So that interest, they need to be capitalized. That means they need to be included as the value of that qualifying asset. Therefore, how do we account for it? So I want us to do an illustration. Illustration on December 2022, question 5D. December 2022, question 5D. December 2022, question 5D. Hoping you're there, December 20, sorry, not 2022, December 2012, sorry, December 2012. December 2012, question 5D. So we are told that Assured Limited borrowed that million to finance two capital projects, A and B, on 1st of January 2010. They borrowed that million to finance two projects. Now, those projects is what we call now the qualifying asset. The money was utilized on two projects as follows. So there's project A, project B. And now we have what we invested on 1st of July 2011. Then on 1st of January 2012. So that's after 6 months. So there was a gap duration of 6 months. Then you're told that unutilized fund on 1st of July 2011 were invested temporarily at the rate of 7% per annum. The rate of the interest on loan was 9%. Required, number one, borrowing costs to be capitalized for each of the project as at 30th of June 2012. We want to determine the borrowing costs to be capitalized. So how do we determine that? Now, in this case, we have two projects. We have project A and we have project B. So first of all, I need to determine the interest expense. Let's read the question again. We'll read the question again. Assured Limited borrowed that million to finance two capital projects, A and B. So here you have two projects. We have project A and project B. The money was utilized on the two projects as follows. So we have project A and project B. Project A is 5 million, 5 million. So that's a total of 10 million. Project B is 10, 10. That's a total of 20 million. And that's how we utilize the 30 million. Come up with the two projects. Then you are told that on 1st of, okay, we have the date of investment. 1st of July, 2011. Now for project A, you invested 5 million, half of this. Then on 1st of January, 2012, that means after 6 months, they invested an additional 5. That's project A. Project B, on 1st of July 2011, they invested 10 million. Then the balance, they invested after 6 months, 10. And that's how you get this is 20, this is 10. I hope now you understand now the framework of that question. Then you're told that unutilized fund on 1st of July 2011. Yeah, the money that you didn't invest or utilize on 1st of January 2011, which is the other half, was invested temporarily at the rate of 7% per annum. So we made an investment. The rate of interest on the loan was 9%. Now, to get this loan of that million, the interest rate was 9%. Now the question is, the borrowing cost to be capitalized. So number one, we determine the interest expense. Now to determine the interest expense, the interest rate was 9%. So you'll take 9%. Project A, we borrowed 10 million. So 9% of 10 million, you'll get is 900,000. Project B, it's 9%. Project B, we borrowed 20 million. And you'll get 1.8. Then you set off against the interest which was earned from the money that was invested temporarily. And that's the interest income. Now we are told that the unutilized fund on 1st of July 2011 were invested temporarily at the rate of return of 7%. So it's 7%. Now, for example, project A, of this 10 million, we invested 5. So that means the unutilized fund was 5 million, which was later invested for the remaining 6 months or after 6 months. So you'll take 7% of 5 million. If you take 7% of 5 million, you get the interest for the year. But they were invested temporarily for only 6 months. So you multiply by 6/12. That one you get is 175,000. Then for project B, you do the same. 7%. We had borrowed 20 million. We invested 10. So that means the unutilized amount was the remaining of 10, which were invested after 6 months. So within that period of 6 months, they were invested temporarily to earn a rate of return of 7%. So take 7% of 10 million, but now only for 6 months, 6/12. So what do you get? So that's 700,000, 6/12, that's 350. And that's now how you get the borrowing cost to be capitalized. Borrowing cost to be capitalized is an amount of 725. And there you get an amount of 1450. Good. As simple as that. Number 2 of the question, the value of the asset in the books of Assured Limited. The value of the asset. You see that the asset that is developed using the borrowed money is what we call the qualifying asset. So how much will it show in the financial statement? So number 2 is the value of the asset. So we have project A, we have project B. And so here we have the amount borrowed or amount invested. Now in project A, we invested 10 million. Project B, we invested 20 million. Those were the amount invested. And then you capitalize the borrowing cost. Then you add the borrowing cost. So here you capitalize an amount of 725. Here an amount of 1450. But what do you get? So you get 10 million, 725. You'll get 21, 450. Now, this is the amount that would now be shown in the financial statement as the value of those assets. Good. So you can take a screenshot of that. Just take a screenshot, you'll copy it. Take a screenshot, you'll copy it. Now let's try another illustration. Open with me September 2021, question 4A. September 2021, question 4A. And we are told that Darubini Limited has provided the following schedule for its long-term loans for the year ended that 1st of December 2020. So you have on 1st of January 2020, that 1st December 2020. Yeah, those are the opening balance and the closing balance. That's a duration of 1 year. So we have 10% loan note that will mature in 2025. We have 12% bond. Yeah, that means will mature in 2028. And then we have 6% debenture, 2024. Additional information. The 10% loan note and 12% bond were used to finance the construction of our power plant. We read again. The 10% loan note and 12% bond were used to finance the construction of a power plant. So that means, you see, for example, in this case, we had one loan. We financed two projects. Now here we have one project which was financed using two loans. If you look at two loans, they are totally different. Maturity period is totally different. Also interest rate is totally different. Now, how do we get the borrowing rate? How do we get the borrowing rate? Now, in case a project is financed by more than one debt, this is how you get the cap rate. You get, or you take the aggregate interest payable, you divide by aggregate, or the total aggregate amount payable. Yeah, that's the amount of the debt. So yeah, I repeat again, we are saying that where a project is financed by more than one debt, to determine the cap rate used to determine the borrowing cost, you will take the aggregate interest payable, you divide by the aggregate amount payable. And we are told that number one, the 10% loan note and 12% bond were used to finance the construction of a power plant. And now let's go to our loans. We have 10% loan note, so we want to determine the interest. So the interest will be 10% of the loan note, of which the loan note was 300,000 plus, you get the interest, 12% bond. So you take 12% of the bond value, which is 200,000, and that's how you get the interest. We have taken 10%, and this is 12%. So this is 30,000 plus 24,000. Then you divide by the aggregate amount borrowed. This is 300,000. This is 200,000. Now give me that in percentage. Give me that in percentage. So you take 30 plus 24. That's 54. 54 divided by 500,000 times 100%. That is 10.8%. Yeah, so that means the borrowing rate for that qualifying asset we use is 10.8. Read again, we are told that. The 10% loan note and 12% bond were used to finance the construction of a power plant, which commenced on 1st of January 2020. Expenditure for the construction was drawn from 100 million being drawn on 1st of January 2020, that's at the beginning, and 75 on 1st of July 2020. That's after how many months? I think that's after 6 months. Then, number two, the 6% debenture was used to finance construction of a new storage facility. So that means the storage facility was financed only using the debenture. So that means that one will lose the cost of the debenture. The construction commenced on 1st of January 2020, but no construction took place between 1st of March 2020 to 31st of May 2020 due to COVID-19 restriction. The facility was available for use on that 1st December 2020, having incurred the construction cost of 60 million. Required. In line with the provision of IAS 23, borrowing cost, determine, number one, borrowing cost to be capitalized for each of the projects as at that 1st December 2010. So we want to determine the borrowing cost. So let's determine the borrowing cost for each project. So here we had two projects. Number one was the power plant. The other one was the storage facility. We want to determine the amount to capitalize. Let's start with number one. The 10% loan note and 12% bond. So if you combine the two, we use the cap rate, which is 10.8%. So we want to determine now the borrowing cost. That's the interest. So you're told that the 100 million, the 10% loan note and 12% bond were used to finance the construction of power plant, which commenced on 1st of January 2020. Expenditure for the construction was drawn with 100 million being drawn from 1st of January 2020 and 75 on 1st of July 2020. And so how much will be the interest? So you'll take 10.8% of 100 million. Also, 10.8%, 6 months to the end of the year, they do an additional 75 million. So of 75 million, but now this 75 million was 6 months to the end of the year. So you take 6/12. So what do you get? So remember the 100 million was invested at the beginning. So that means you account the interest for the entire year. Then another 75 was drawn 6 months to the end of the year. So determine the interest for the remaining 6 months. So you take, so you'll get is 10,800 you'll get an amount of 4050, and the total will be 14,850. Get a total of 14,850. What about to the storage facility? Now, storage facility is very simple. Number 2, I told that the 6% debenture was used to finance the construction of a new storage facility. The construction commenced on 1st of January 2020. That's at the beginning of the year. But no construction took place between 1st of March to that 1st of May due to COVID-19 restriction. So there was a period under suspense. Now, the period under suspense, or the period when there is no work going on, you don't capitalize that expense. Rather, you expense. So we are told that from 1st of March to that 1st of May, those are how many months? Those are 3 months. So for 3 months, there was period of suspense. So that means when computing the interest for the year, you eliminate the interest for that period. You don't capitalize. Yes, you pay the interest, but that interest for that period, you expense it to the income statement. It will not be capitalized. The facility was available on that 1st December 2020, having incurred the construction cost of 60 million. So incurred all the 60 million. So in our debt, we had 6% debenture. So the interest will be 6% of 60 million. You get the interest for the year, but there was 3 months under suspense. So that means you only factor in 9 of the 12 months. That's how you get the amount now to capitalize. And what do you get? You get an amount of 2.7. Good. Number 2 of the question. Number 2. The value of the asset in the books of Darubini Limited. Value of the asset. So we have the power plant. Here we have the storage facility. So you'll take the amount invested. So by the end of the year, for the power plant, we have already invested an amount of 175 million. 100 million at the beginning. After 6 months, we invested additional 75. For storage facility, we invested the entire 60 million. That's the amount borrowed. Then you add the borrowing cost. For the borrowing cost, here you capitalize an amount of 14,850. Here you have an amount of 27. Good. And that's how you get the value of the asset now to be capitalized. Good. So that means when presenting the financial statement at the end of the year, now under non-current asset, you'll show an amount of PPE, or the plant, property, and equipment. Now for the power plant, the amount to be shown, you show an amount of 189,850. For the storage facility, you show an amount of 62,700. Good. And now you are somewhere. We'll do more illustration during our revision. So now you can take a screenshot of that, and that marks the end of that session.